6th insurrection, in his words, an insurrection fueled by lies about the 2020 election. But of course, he tried to spin to something positive, the idea that we as a people endured, we did not flinch, and we prevailed. He's set to provide the Citizens Medal, the second highest civilian honor that the president can give, to several people, including at least 3 officers who were there that day to protect us. Michael Fanone of the Metropolitan Police Department, Eugene Goodman, and Brian Sicknick of the Capitol Police Department. Of course, Brian Sicknick will get his award posthumously. We want to go now down to Ryan Teague Beckwith, who has been covering this story for us from the beginning. Ryan, give us a sense here as to the importance of this ceremony, and it is symbolic in a lot of ways, particularly against the backdrop of the fight going on right now amongst the Republican Party to elect a leader of the House of Representatives.
Thanks. It's important to look at the range of people that he's honoring here. It includes elections officials who were under fire in the immediate wake of the election, political leaders like Rusty Bowers in Arizona, who is a Republican who was directly pressured by former President Trump to try to take some action to overturn the election result, as well as the officers who defended the Capitol. So he's really casting a big picture look at this, not just focusing on the attack on the Capitol, but on President Trump's attack sort of on the democratic result of the election. I think that is something that the president has done repeatedly in trying to establish what January 6th meant. He gave 2 speeches last year that sought to highlight the issue of the threat to democracy ahead of the elections, even though that was an issue that Democrats as a whole were not playing up in their campaigns. They were more focused on kitchen table issues. So this is something that's very personal. It's something that is very much a goal of his as president to highlight.
All right, Ryan, I'm going to leave it there. Ryan Teague Beckwith down in Washington, the President of the United States, continuing that ceremony. If you have a Bloomberg terminal, you can go live, to continue watching that. In the meantime, we do want to get to some breaking news. Increased demand, but the company says it will also need to cut corporate jobs as it winds down other priorities, and that it will hopefully finalize that plan for job cuts by April 3rd. Katie.
And of course, it is a Friday news dump. We also have news coming out of the crypto sphere. The headline that FTX debtors and FTX digital markets, they've reached a cooperation agreement. They've agreed on terms for mutual cooperation in the Chapter 11 cases and the provisional liquidation of FTX digital markets. This is according to a statement. We're going to continue to follow this story as the FTX implosion and the aftermath continues, Romain. All
right, a lot we're trying to pack in today, and we want to get back to the markets and specifically talk about private equity with the potential recession looming as we come into 2023. There are a lot of sectors that have been seeing the effects. After investing in 6 recessions, our next guest is here to discuss what to expect this year. And let's face it, guys, you cannot talk about private equity, at least not the modern era of it, and not talk about Scott Sperling. He's now the co-CEO over at Thomas H. Lee Partners, a leading private equity firm that has several $1 billion of assets under management. Great to have you here.
Thank you very much for having me.
Let's just start off with sentiment. I mean, I know people like you're always looking for opportunities. You always sort of have to find sort of that bright side, if you will, or at least opportunity. I mean, how do you do that right now in this environment?
I think the first thing you have to do is recognize the incredibly high level of uncertainty, not just about pricing in the near term, but about what is the nature of equity valuation 4 and 5 years down the road when we're in a very different environment than the one we have been in for the last 4 or 5 years. I mean, we had remarkably high multiples across a broad spectrum of industries and businesses, and it was all driven by a massive infusion of capital coming from monetary stimulus and then fiscal stimulus that we've never seen before. There was a whole series of anti-inflationary forces through the last 20 to 30 years that allowed that capital to flow in without creating inflation. So whether it was technologies that were used to be able to produce energy at ever lower prices because of the amount of supply, whether it was globalization where we shifted manufacturing to much lower cost geographies, or it was a whole set of deregulatory efforts efforts that are mitigated. So we're now in a very different world where the Fed is trying to deal with probably the most insidious of all economic problems, which is inflation. Because we know that really undercuts almost everything else. And they're willing to take a recession, I think, in order to make inroads into bringing inflation back under control.
Right.
But where does it go to? Does it go to 2% or does it go to 4%? The likelihood is we're not going back to zero cost money. We're probably going to have higher cost money. So what does that do to multiples? When we're buying businesses that we think are good businesses in really good sectors that have very strong fundamental growth trends.
Right.
We're trying to work with them to make them better, improve their key business processes. And then we're looking to eventually realize for our investors. Part of that calculus is what do we think the multiples on those kinds of really good businesses are going to be a few years out.
Well, that thought process of multiples, or I guess the multiples change. Does it change your cost of capital? Does it change sort of how you assess, how you fund these deals?
Absolutely does. I mean, one way of thinking about the last year from not just private equity, but from a broader perspective, is in March, we were financing deals where the senior debt cost us 4 or 5%. Today, it's 12%. So in a 9-month period, you've seen a massive increase in the cost of financing the exact same company. And the implication of that for how we value those companies is something that one needs to take into consideration. Now, the massive meltdown of really good sectors, the technology sectors, for example, in the public markets does create opportunity. In the private markets, if you're a private owner, you're probably still hoping that's temporary. And we haven't seen a lot of good companies come onto the market to be transacted at prices that we'd be willing to pay. But I think that's a matter of time. So we're looking at the next couple of years as one that would interestingly be a very good period for buying. We've looked at the last few years where we've had massive realizations at prices that were probably higher than we ever modeled or expected.
Well,
and we're looking at that cycle.
Before we get to what you're going to buy, I want to talk about what you own right now. And one of your portfolio companies, Auction.com. So as I understand it, it sells foreclosed homes, which is a really interesting topic at this moment.
Yes.
What do you see in the pipeline for foreclosures?
So Auction.com is a marketplace. It's an automated marketplace where owners of transact at much lower cost. So they're able to move more rapidly when they have that situation. So we're not directly involved in foreclosing or any aspect of that. Rather, we're a technology platform, a marketplace that allows that to happen. Now, I think fundamental to your question is we haven't had a upward blip in foreclosures. I would expect when we go into a more difficult period, which I think we all expect to do, there will be more foreclosures. Our hope is that an Auction.com allows that to occur with many fewer errors than what we saw happen in the 2007-8 period. It gives more flexibility to the owners of those properties or the holders of that mortgage paper like Fannie and Freddie and others to work more with people. And when needed, this is a good, very efficient, very low-cost way to deal with the actual transaction that goes along with the foreclosure.
One other investment that we were talking about when we were preparing for you was Hightower. And sort of what's all going on in wealth management and with registered advisors and how much has changed just over the last couple of years.
So one of the ways that we work is that we want to be domain experts in subsectors that we think have really strong growth trends. And we're looking at all the fundamentals that might drive that. So we're a very big player, for example, in automation, where we're the only firm with an automation fund. We've been a long-time player in fintech and financial services. And our team there identified the very strong trend of moving away from, for regulatory reasons, wirehouses to the RIAs, the independent advisors. And so we bought a good platform, Hightower. I think at the time it had something like 20 some odd $20 million EBITDA. And now 4 years later, it has over 200 million of EBITDA as we use it both to consolidate the industry, but also to build into that company technology platforms that make it a better, more efficient player.
All right, Scott, I'm sorry that we have to leave it there. Great to have you. Scott Sperling of Thomas H. Lee Partners. We'll be back in a moment. This is Bloomberg.
Double up with Mary Brown's Chicken. Get 2 of your favorite chicken sandwiches, 2 small taters, and 2 cans of pop for just $20. 2 sandwiches, 2 small taters, and 2 pops. 2 for 20 sandwich combos. Now at Mary Brown's Chicken. Crave delicious, crave Canadian.
The Equinox RS can keep you connected.
Alexa, remove chips from my shopping list. I've checked off chips from your shopping list.
Until you want to disconnect.
All right, a 20 basis point drop in short-term treasury yields and a 2 to 3% rise in equities. All this because of a labor market report that did show some tempering in some of those wage gains.
Data matters. You look at the S&P 500 near session highs, 2.4%. You look at what's leading that. It's actually Costco is your biggest percentage gainer in the S&P 500 right now. But this is a broad-based rally. Every single sector is higher right now, Romaine.
Yeah, but not to be sort of the Debbie Downer here. Negative 106 on your 3-month, 10-year curve. That is normally a recession signal. So I am curious as to how we sort of reconcile all this.
It's a good question. Same things on the 2s, 10s as well. Those yield curves are sending a message, but no one's listening today.
All asset classes right now moving dramatically here on the final trading day of the week, first week of the year. This is Bloomberg.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes to go here in the trading session. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovec. Welcome to our audiences across Bloomberg Television, Radio Quick Take, as well as on YouTube. We knew that the big jobs report earlier today was going to be big, Carol.
Yeah.
It was big. At least that's the market's reaction to it.
Yeah. You know, when you're at a poker table and you're like all in, because that's what it feels like, both on the stock and bond markets. It's interesting. Once again, we see that correlation both to the upside. We've seen yields back off. What's interesting, okay, so it looks like everybody's bullish on a lot of sectors, certainly in the U.S. market. What is pulling back after quite a run this week is, again, those Chinese names that trade in the United States. They're down about 1%, so a little bit of a paring back. But keep in mind, they're up about 13% this week. Our spotlight story on the Bloomberg talking about investors loading up on greater China stocks. Best start to a year since 2009 for China shares, also listed in Hong Kong. So this is certainly already one of the bullish trades, at least early on in 2023.
I was also looking for some stocks that were sitting out this rally and, you know, not ignoring what's happening on Capitol Hill right now, Romaine. We actually see defense stocks falling, and you can see right there for our TV audience, falling just after noon today on news that the emerging deal that Republican Kevin McCarthy is in discussion now to make him Speaker of the House. He still isn't. It would propose a roughly $75 billion cut in defense spending. So we're seeing shares of, you know, Lockheed Martin are lower, Northrop Grumman lower right now. Still, 8 of the 10 stocks in the S&P 500 Aerospace and Defense Index, they are higher. Speaks to the, you know, just how broad this rally is.
Yeah, and it also gets to the point that Washington still does matter, at least when it comes to money. We go back to the headline markets here, 3,900, pretty much even on the S&P 500, up about 2.4% here on the day. And most of the gains that we're seeing on the other indexes pretty much tracking that. The Dow up about 2%, the NASDAQ up almost 3%, the Russell up about 2%, Dow Transport's up almost 4%.
And you take a look at what's happening on the sector level, it's the same story. There's a lot of green on this chart. You have materials leading the way, up 3.4%. You also have tech doing really well today, up over 3% as well. Really has the blessing of the bond market when we see that dramatic move in yields. At the bottom, healthcare, that's the relative laggard, but it's still up over 1%. So really a lot of muscle behind what we're seeing at the benchmark level.
Yeah, we talk about some of the individual movers. I think it was either you or Tim or Carol brought it up the other day, but Warner Brothers Discovery up again here, 6 straight days of gains for the company, longest win streak since it's been a public company in its short life since the middle of last year, up 4% here on the day. And I was taking a look at Target. This was interesting. Target has been on a bit of a stealth rally. It's up 4% today. This is actually its 9th day of gains, straight day of gains. And that's the longest daily win streak out there right now, at least among the larger cap stocks out there here. And the longest daily win streak that Target has had in and of itself, going back to a 10-day run that it had in 2018 here. Tesla getting a little bit of a rebound here on the day, up about 3%, though we should point out on a weekly basis, it's one of the worst performers in the S&P 500. And some of the concerns that we've seen about deliveries and, more importantly, pricing on Tesla vehicles, that's actually dragging down some of the Chinese EV makers, including XPeng, the ADRs of that company, down about 15% here on the day. But of course, the big news really goes back to that jobs support. Everyone was so for wage numbers, some degree of moderation year over year. That is a lot. That's good news, but it is a moderation from what we had seen before. And guys, this is what Jay Powell had talked about. This is what a lot of folks had talked about. The idea here that, yeah, the Fed was interested in weakening the labor market overall, but it was much more concerned here about making sure that wage growth was much more in line with, I guess, economic conditions that the Fed itself was willing to support.
Yeah, Romaine, such an interesting report. We are definitely living in unusual times when it comes to, how the economic data continues to play out, and addressing kind of the uniqueness of it all is Randy needs to come at us. Check it out.
Immaculate disinflation report that you're starting to get lowered wage growth, but lower unemployment rate, continued high growth in jobs. As I said before, this has never happened before.
Gotta love that immaculate disinflation report. I'm getting T-shirts already made up. But of course, that's Randy Kroszner, formerly a Fed governor, now at the Chicago Booth School of Business.
Well, be careful when you start printing up T-shirts and hats, because that usually means the end of a rally here. By the way, glad that you and Katie got the same memo on the purple dresses today.
Oh my God, we look great.
You do. You both
Doesn't
look
it look
great.
nice?
Yeah.
It just looks work. But isn't it interesting times? And he talked about maybe 25 basis points at the next, I think, the February and March Fed meetings. That's how he's seeing it. But there's a lot of debate about what we get.
Well, what did you see also? I mean, we played the clip from Randall Kroszner, but Larry Summers was also on Bloomberg Television a little bit earlier. Actually, that full interview is going to be on Wall Street Week later tonight. But he actually was concerned about this idea here that maybe we're getting a little bit ahead of ourselves, and some of the issues with inflation are much more structural. So even if the Fed sort of meets its general goal of trying to tamp it down, there are structural issues that are just going to sort of rear their head down the road.
But the Fed still has a long way to go to get those, to get inflation tamped down. We were reminded by that with a handful of Fed speakers today. And it brings me to the question, is this rally essentially fighting the Fed? Are they ignoring these Fed speakers who are coming out even after a jobs report immaculate disinflation report, as he described it, that shows that we are seeing some improvement, but we've still got a long way to go.
It does feel like this could be the seeds of an overreaction. When you look at a 20 basis point move on the 2-year Treasury bond, I mean, that is the largest move since November, since we got that, one of those latest rounds of CPI showing that maybe the tide has turned. I mean, this is a market just trying to follow the same data that the Fed has.
Sorry.
2 years close to 2%. We like buying that protection in case the market's wrong there.
And Mimi, I want to talk about what worked last year and spin that forward into what will work this year, especially as we piece together the first data releases of 2023. What worked last year, it was cash and it was energy stocks. Is that going to be the case this year? Again, when you look at just the first drips of data that we've been getting.
Yeah, so take us back a year ago, we were underweight equities. We were very cautious on valuations, especially in the tech sector. We were underweight fixed income, we were short duration, and we were long overweight in the commodity space. Here, we're just neutral across the board, the most neutral we've been in 10 years, actually. So especially I would draw attention to bond yields. If you look out over a 10-year horizon, these are really fair levels. So I think that you do want to have allocations to fixed income. Emerging market bonds, for instance, yielding over 7%. Fed is priced to get to 5%. So across the curve, have a lot more value there. On the commodity side, we've really squared up to neutral there. And equities, we think will be range bound for a while this year.
So does that mean, though, then some of the correlations that we saw last year, kind of the everything sell-off, or stocks went down, bonds went down, those correlations, I guess, sort of break? And so the idea is that maybe fixed income starts actually acting like what fixed income is supposed to do in a portfolio.
We do think that going forward, fixed income will provide more of a buffer. Today is a bit unusual because as we see improvements on the inflation front and softening in the manufacturing, as you mentioned, then you can kind of see both of them prevail. But overall, we think that fixed income will provide some cushion in down trades and equities.
Most neutral in a decade.
That we have on right now, we're long Norway. We think energy independence is going to be a big thing still. Structurally, we do still like energy producers. Other tilts were long emerging market debt, as I mentioned, yields north of 7%, and then front end tips, because we think that they're really priced to perfection. We think that there could be some upside there.
We were talking a little during there in rallying, not only in EM equities, but of course EM bonds as well. This idea that this could be sort of that year